This is our Forex block for June 5th, 2013, and these are our currency indexes, which is, in my opinion, the easiest way to trade because it's one of the most predictive and anticipatory ways of trading. And basically, we are statistically comparing every dollar pair, yen pair, euro, and so forth, and creating a chart of that. And it lets you see a wealth of information, such as the previous day's dollar index high. Notice how it acts as resistance. Previous day's dollar index low, access support. These are key areas, and so you can look at a chart and say, wow, the Swiss at 8 o'clock is stronger today than it was all day yesterday. The daily trend and weekly trend is both strongly up, so this is obviously a currency you want to buy. And what is the weakest one? Well, you can look at it and immediately see the Australian. Daily trends down, weekly trends down, and gets weaker. It broke the previous day's low here at 1 o'clock. This is oftentimes when lows are broken, it trends down the whole day. At that point, the yen, a little bit before that, had already been trending up. Now, our containment bands tend to contain price, and oftentimes when price gets to this level, it can reverse. It can go higher, but you can see this one kind of went sideways, up, and then down. It had a hard time going higher. The pound is not at its upper containment band, so when the Australian broke down right here, the Swiss was going up, went above, from below to above its hourly, the weekly trends up, the daily trends up. I would say look for Australian Swiss buys. That's one of the higher probability trades you can see. It doesn't matter what time frame chart you're using. I use 5-minute charts just because it comes up fast, but you can use tick charts, range charts, and you can just quickly see on this chart, it's underneath its hourly moving average. The lower containment band is way down here. It has a potential of 60 to 70 pips to go down, or even more. Sometimes the containment bands get broken, but the vast majority of the time, when the 2.0 white band gets hit, you're going to get a stall sideways, or what oftentimes happens is a reversal. So, where do you sell when you know a currency is likely to go down? Well, a lot of times you're not going to get a pullback. The best trades are when you have a trend that's down, you wait for a pullback, you get short, right? Like right earlier here yesterday. It went down, you get a pullback, you sell, down, pullback, you sell, maybe a small loss, break even, 5 or 6 pip win, another pullback short, huge win. And when you know the trend, you can use the perfect oscillator, either the plus 80 levels or almost ideal, and you can see this one worked, this one worked, this one did not work, this one here also worked, or the upper containment band. In fact, this one made a higher high with a lower perfect oscillator reading, and it hit the upper Bollinger Band of our perfect oscillator. And you'll never get this perfect oscillator anywhere else. I came up with it. It's based on the last 20 days statistics and how far the market moves for that time of the day. It's a very complex mathematical formula. It doesn't use look-back periods. And I called it perfect oscillator because it is one of the highest degree of accuracy timing tools I've ever found. So when you have our indexes to pick the chart, and then whether you use a tick chart, a range chart, 1 minute, 2 minute, 5 minute, 15, doesn't even matter, chart to, or range chart to find the entries, basically wait for a pullback or a sideways rectangle pattern. So you can see that this one, once it broke that low right here, fell from 91.20 pretty much down to 90.60. That was a 60 pip move. I just kind of guessed where the lower band was. This is where I always estimate my profit target. Let's just round up to 80. If you short this right here at 30, you have 50 pips potential profit. And when you go short, you just put your stop above the last swing high. And a lot of times on these type of things, I will, when it breaks down, I put my stop right above the breakdown bar is high. So I'm risking just absolutely ridiculous tiny amounts. I like to trade larger lot sizes and not be as nervous. I don't like to, when you add the spread to it, this trade might result in a 7 or 8 pip loss. That's fine for me. And when it goes down and goes sideways, I tend to get out of half, draw my fibs on the first wave, and the fib targets are down here, lower bands are down here. Perfect oscillator hit an extreme, so somewhere in this zone I would get out of the second half. If you average those two exits together here in the middle of here, the exit might be somewhere here. So you can see the average exit price is many multiples of what the risk is. And that's the key to trading. And that's the key to stress-free trading too. Ideally you want to be buying the strongest currencies. I mean, you can see, and I like when an area acts as resistance, because normally there is some selling at the previous day's high. There is some buying at the previous day's low, as you can see here in the CAD. It's not easily able to make new lows today. So when a currency finds resistance, comes down, and starts to pop up, that's a trend that's very likely to go up, and you have your fib, you draw your fibs off the previous wave, you have an idea of where your profit target is already, and at this point you could, some of the weakest ones, the ones that are underneath the hourly and the daily and weekly trend are the weakest. You have the CAD, that's the weakest of all at that point in time, because it looks like it's about to break down and go underneath the previous day's low. You can also see the point of control the previous week was down 71 pips, and yesterday the average price for yesterday was down 3 pips. So, yesterday it had a slightly down day as far as the most actively traded price, and last week was a big week down. Selling the CAD yen or the Australian yen makes sense at a little bit before 1. CAD yen, a little bit before 1. Take a look at this. You might have saw that somewhere around here. You can put your stop above the swing high. You draw your fibs off this previous wave. You have your profit target down here. And you also, when this thing's starting to go down, you can see in an extreme, typically these perfect oscillator values are the most accurate when they also line up with the lower containment bands, or underneath them. As far as the pullback areas, a lot of times markets, when they've gone down a lot, will make a 2-wave pullback, 1 wave, 2 wave. Selling the second wave is one of the higher probability trades also. And I like to sell the fib targets of the first move. Let's draw this on there correctly. And you can see, look, to the pip. What I typically do in this situation is I'll get into pretty decent sized position, and then because there's resistance above it at the 1.618 fib and the hourly moving averages right there, I'll tend to get in a progressively bigger right here, which yanks my average price up to here if it would go against me a little bit. And then, kind of usually after a big move up, down, up, they're going to pull back a little bit. Depending on how the speed of it down, I might lighten my load a bit. In this case, I wouldn't have been able to scale in. It immediately went my way. This isn't enough of a pullback to get out of half. This area right here, I would have probably got out of half, and then when it goes sideways right here, I'm out. But the key to trading is small losses, big wins. Whether you got into this earlier trade right here and you got out somewhere down towards the bottom, your risk versus your reward is huge. In this case, the entry on the 2-wave pullback, your entry, and let's just say you got out of it right here and you missed some extra pips here, another 10 pips here, you got 2/3 or maybe 60%, 55% of the total amount of pips to be made. Your risk is about, the risk reward ratio is maybe 3 to 1 or 2.5 to 1. That makes sense. And another thing that you can do, especially after it makes a move down, you draw your fibs on there, and let's pick the high here. Typically the 50 to 62% retracement is where you want to get into the trade. So, but you never know where it's going to stall. I kind of wait for it and hope for it to stall here. And if it goes sideways, I'll get in lightly, and then I'll scale in at the 62%. In this case, it shot right through the first one, even above the second one. The first down bar right here might get into a little bit of a position. And then it started to go my way, and then against me, and then a little bit my way, and then against me. Anytime it makes a false breakout over the highs and comes back down, I'll typically add to my position. That's usually a good sign the trade's going to work. Traders that are had bought the bottom are going to be really excited right here when it starts to go above the high, and when it comes back in, they're going to get all nervous because they know the trend's down. Counter trend traders tend to bail much quicker than trend traders, and boom, you can see a huge move. Look where it went, right to the fib target, right to our lower band, and it's very close to the -80 level. So there's not really much left for profit in this. Most of the time, when the minus 80 level gets hit, you're going to get some kind of reversal. And keep in mind it's based on that time of the day's volatility. So if from 1 o'clock to 2 o'clock here, the market doesn't move that much, you can have plus 80 levels get hit. So I'm aware of that, and I trade, during less volatile times, I'm less likely to just get short right here. If I see that level get hit, I'm excited. I know the trend's down, I want to get short. You just kind of draw a trend line underneath those bars low, and when it breaks down right here, you're short, and put your stop over the high. And a lot of times during the dead time of the day, the lower volatility times of the day, double tops, double bottoms make perfect profit targets. And when it comes down and doesn't explode through that level, you want to get out. When it hits the lower Bollinger Band here, you got to be aware that it's likely to kind of run out of steam. Usually when these levels get hit, the market is soon to reverse after. Notice it got hit right here and the market reversed 15 minutes later. Right here, the market reversed immediately. Right here, went underneath that level, it reversed quickly. So don't be greedy. Use the perfect oscillator. The only flaws it has is during dead times of the day, you can see extreme moves on this and markets can keep going. It's much less likely to happen during the more volatile times from 3 to maybe 11. If you notice how many times it hits the upper and lower either Bollinger Band or the minus 80 level, you tend to get reversals. Obviously this one's a failure. This one was successful, this one was successful, this one was successful, this one was successful and went up, this one was successful and went down. This one, you could say it's somewhat successful, went up 12 pips. This one nailed it, and we know the trend's down, so that's a no-brainer trade. This one nailed it, and this one here, pretty much you could say that failed because although it did go slightly higher and then pull back, it kind of went against you. You probably would have had a loss on that. But you can see the vast majority of the time during the active trading times, the perfect oscillator and the Bollinger Bands around it are exceptionally powerful and work. So we'll do one more example today in how to anticipate future price direction, because that's the easiest way to make money. And there's a lot of ways to do it. You can draw fibs. Let's say the yen here. It goes up to the fib target right here, and you look for sells at the upper level, especially near the 2.0 white band. If it's at the 1.618 and the 2.0 white band, it's likely to kind of run out of steam up here. And even the first time it comes up, shoots through the first one, you know that the 1.618 probably 70-80% of the time is going to be the high. At 135, you want to sell the yen versus one that's likely to go up. So which one is likely to go? You can see the Swiss is starting to poke its head above water right here. It has plenty of room to go if it works its way up to the previous day's high right here. So let's take a look at looking for buys at 135 in the Swiss yen. Now remember, the yen's the strongest one. So, but the point is, at 135, which is right around here, we're looking to buy. This happens to be right near the lower band. I would prefer the lower perfect oscillator be down here, or even at the lower band. It's not. That's the only downside here. But if you did a light trade right here, you can see it popped 20 pips, pulled back again, popped 30 pips. There's two trends down there because the Swiss looked like it was about to go up, and the yen had gone up too much and was likely to reverse. It was more likely to reverse than continue. And so if you see a trade like that, if you find the strongest one to trade against one that's likely to, maybe it's up too much, like the yen's likely to come down, you can make nice little profits, 10 to 20 pips, sometimes 30 pips, doing counter trend trades. Let's look for one other one with the yen at that time. Again, the yen's very likely to reverse. The pound, daily trend, weekly trend's up. It's been going sideways all day. It looks like it's trying to peek its head above the hourly right here. If it breaks out, it could explode. So let's take a look at the pound yen. This is a little bit lower odds than the last one. But at 130, we're likely to get a bounce. And of course, look what happened here. Hit the lower band. You got about a 20 or 30 pip bounce. It pulled back again. You have a double bottom. This one's underneath the lower Bollinger Band. And another way, I haven't shared this that often, the white line in the middle is the moving average of the perfect oscillator, and the gray lines are the Bollinger Bands around it. If you see the moving average sloping up, it means that the momentum is reversing to the upside. And so it's even more likely to bounce off when the perfect oscillator hits the minus level. It's at the lower containment band. This is a very high probability trade. In fact, I'd get in when it stalls right here at the previous swing high and get out of half, and then when it rallies up here, I'd probably get out of the other half, because usually the hourly is your maximum profit on counter trend trades. You can also look for divergence in the moving average. Right here you have divergence. The price the first time versus the second time, you can see the price on the chart has gone up. The moving average of the perfect oscillator has gone down, and when that happens, a lot of times when it hits the upper band right here, that's right around this level right here, big move down. Now notice the moving average is sloped down, comes up and hits the upper band right after that. Notice this nice little 20-25 pip move. And you also might look at the middle line. If the moving average is above the middle line, you're more likely to buy the lower bands. But also keep things, a lot of trading is common sense. So for instance, this is one big move up, and the previous trend was down. So is it going to have just a tiny little pullback before it goes up, or is it going to, is it likely to pull back at least 38%, which is likely to be down here? I say it's more likely to go down a decent amount, 35 to or 38%, 50, 62% fib levels, and that would make it underneath the hourly, which makes it more likely to go down. So just use common sense. Watch all of our videos to learn the 20 or 22 different aspects of trading, and incorporate all those into your trading too, and you'll do even better.